Hey folks, welcome to CFO Chat. As always, your weekly, most comprehensive look at the world of business, finance, and economics. We are sitting down with the General Manager in charge of finance at Kenya Power following earning on steroids for FY2023-24, 30 billion in net earnings. Steve, karibu sana.
Thank you very much, Julian.
Steve, we've had some very tough conversations before. I'm delighted that this time is really on a positive note. So let's start from here. Looking at your numbers, your revenues are up 21%. Your costs are up by a marginal 5%. It looks like you really didn't sweat your business to unlock these earnings. Is it principally a function of the tariff revision?
Really, not entirely the tariff function. If you look at our half-year earnings, the tariff was actually already in play. The tariff was approved in April 2023, and so by the half year, the entire half year was within the new tariff. Now, the key dynamic there is it just goes to show the kind of impact that Forex has on our cost of sales, because the revenue growth was actually expected in terms of the plans that we have and the initiatives that we are implementing, as well considering the tariff. But then the power purchase cost, when we had the change in the Forex dynamics in February, that is the second half of the year, quite significantly, even the obligations that we had accumulated because of the unavailability of Forex in the first half of the year now became payable at a much lower exchange rate.
Yes.
And so we actually had a realized gain in the cost of sales that actually brought down the power purchase cost quite significantly. And that speaks to the increase in the margin between the revenue and the cost of sales quite a bit.
Which is quite significant. But speaking about the debt aspect of it, there was the COVID-19 induced moratorium, which you do indicate when it expired in June 24, you decided we are not renewing it. How does the new repayment schedule look like, and what kind of weight is it inflicting in your financials?
The moratorium was first a 1-year moratorium, then extended up to June 2024. And during that extension, actually there was interest accruing, and also the amount that had been deferred. So that interest now was capitalized. And what we did, the government was actually discussing the balance sheet restructure, and that was part of the discussion because the transfer of assets, once they are valued to KETRACO, is supposed to net off on that balance of on-lent loans. And so when the moratorium expired, there was expectation that KPLC would apply for an extension to be able to finish the valuation of the assets and the transfer. But as an entity, we looked at that and realized that we are continuing to build this obligation by accruing interest, and we are not paying the loans, and the Forex impact has been quite devastating on our performance.
Yeah.
And so we made a deliberate decision to start the repayment. So what we did is we actually wrote to National Treasury and proposed to recapitalize based on when they were approving the moratorium. They had given specific conditions on how the moratorium will go, and when actually it matures, how we will be able to deal with the accrued amount. So we did that, and we computed our schedules based on the terms of the loan, and started our payment. And so far they have acknowledged our payment, and now we are moving on with the repayment. As I said, between July and September, we've paid 3.3 billion shillings, and that is reflective because these loans are actually paid on a semi-annual basis. But because they are quite a number, there are about 8 loans. Yeah. So there are those that are in the September-March period. There are those that are in June-December period. And so in total, we expect to pay about in the regions of about 11.5 to 12 billion shillings in the financial year.
Okay. And speaking about the transfer of some assets to KETRACO, following their designation as a systems operator, what does the aggregate valuation of these assets look like, and how soon do you look to do that final transition?
The valuation of our assets, we actually carry our assets on a historical basis, historical cost basis. And what that means is that the price at which we bought them less the depreciation or amortization. And so you'd find that quite a number of our assets that have very long useful lives are actually really undervalued
yes,
as such. And that speaks to really even the valuation of the company itself when you look at it from the balance sheet as such, because these assets are the ones that generate the revenue that we are seeing as such. And so the process of valuation, the intention here, if you were to go by what the cabinet approved, was that the transfer is done based on a commercial valuation. And so there was a process to get really the experts to do the valuation, and they have started. And you know, the unique thing here is that these assets are assets that are traversing and in various regions across the country and all that. They have other aspects like the way leaves they sit on and and all that.
Yeah.
And some of them have improvements that have been happening over time, and you'd find newer components within a particular substation, for example, and all that. They have fiber on them, so they have other revenue streams and some revenue share in terms of co-location for the telcos. So putting all that together, then we expect that the valuers that we have on board will be able to come up with the commercial values that will now be considered for the transfer. But then also, what I should mention as well is that the initial intent, the underlying issue of the transfer of assets was actually the balance sheet restructure of KPLC.
Yes.
And looking at the negative working capital. And so if you look at the improvement of the negative working capital and the far that we've come, you just alluded to the fact that within the next 1 or so years, we should be able to come out of that. I think that also weighs into what should we transfer or what should we not transfer, and to what extent as such, if we now have a stronger balance, because these are the same assets that we use in terms of some of our customers are actually connected at transmission voltage, and so we might not be able to transfer those kind of assets as such. And also you talked about the control function, the national control function. Actually, that control function runs the system that runs even the distribution grid. And so the transfer of that, KETRACO is actually building their own national control, and it's expected once they are able to complete, and then discussions around that, the transfer of that would actually continue.
Steve, on the negative working capital, and this was really the sweet spot for me in these earnings, because you and I have been having this conversation for quite a while. The decline year on year, 27, just about some 20-something billion shillings, quite steep. It looks like in FY2024, one, you'll be extinguishing this issue of the negative working capital, and two, and more fundamentally, just walk us through how you have walked through this recuperation journey of your working capital.
It has been quite a very delicate journey, and really being very intentional. The utility appears to be a mature utility, but then still quite expanding. And you know, the process of expanding, in our case, you'd find that you tend to convert a lot of your current assets into long-term assets as such, and it leaves you with current liabilities in the name of what you have to pay your suppliers of materials and the contractors and all that. And so we are at a time when we are starting out to really invest in our grid, quite especially because of the performance and where the business has improved and all that. We really need to do the refurbishment and maintenance of our networks to be able to serve our customers very well. And that speaks to really some pulling back into a bit of the things that would actually affect the working capital. But the journey has been, we actually scaled down our investments to very critical maintenance capex and very critical high impact projects over time. And that supported the kind of healing that we've seen on the negative working capital, and also really being very specific in where we invest the funds that we have, and also trying to really optimize in terms of our debt book and all that. During this particular period, there are instances where we've done some prepayments to some loans when we evaluate and see really that based on a cost-benefit analysis that prepaying part of a very expensive loan would actually give us some arbitrage in terms of benefits. Then we are able to prepay that. And what that does on the negative working capital, it reduces the amount of loan that is repayable within 1 year, and that helps to improve the working capital.
I raised this with you, Steve, that in the latest annual public debt survey, one thing that stands out to me is that unlike in the past where we have had Kenya Power being captured under guaranteed debt, including last year, this year we don't seem to be seeing Kenya Power under that consideration. What could have happened here? I
would actually associate that with the fact that what Kenya Power has is on-lent debt. Yeah. And KPLC is actually 50.1 owned by government, and 49%, almost 50-50, listed on the securities exchange. What that means is that there are private investors within the company, and the government would not specifically or entirely guarantee debt really to a company that is almost half private as such. And so what the government does, and still to afford us the concessional, being able to get some concessional financing, is that they actually on-lend this. So it's the government that has borrowed. There's a financing government between the lender and the government, and then there's an on-lent government that now comes to KPLC and quite matches the terms of the financing agreement, but now with a bit of the conditionalities that would come from government to KPLC, because KPLC also has some private shareholding in it.
Okay. And you've mentioned that effective FY26, you want to have extinguished all commercial hard currency denominated debt.
Yeah, that's actually one of my very, very key objectives. And that is entirely informed by the fact that Kenya Power revenues are entirely in Kenya shillings.
Yeah.
And so even as we venture into some FX revenues around fiber and also trying to get some of our customers to pay us in foreign currency, that will be to take care of the cost of sales, which is long-term and it is denominated in foreign currency. And so that is the risk that is very difficult to deal with in terms of the FX risk of the cost of sales because of the nature of the contracts and all that. You can't convert that. But on the debt side, there are a few flexibilities here that we can be able to really leverage on and then reduce the exposure that the forex exposure that comes with that. And so that I'm very deliberate about working towards June 2026, where we do not have any hard currency commercial debt as such. And the expectation is that, again, with the paying down of the online debt from government, we should be able as well to have reduced that quantum. And going by what can be slashed off in the transfer, if at all, as such, then we would also have a very lean online debt on that. I mentioned around the green financing from the World Bank, which is a $400 million facility. But for KPLC, and during the negotiation, actually, one of the make or break points for KPLC was the currency, because we wouldn't be going through a process of even trying to transfer our assets to offset hard currency loan, and we are bringing on additional hard. It would actually be counterproductive. So in that, the government at that time was gracious enough and really to actually take up on the FX risk, because KPLC, the online agreement to KPLC is in Kenya shillings.
Okay.
Yeah.
It sounds to me like Kenya Power and this country by at large is in a dilemma. These earnings this morning have been heavily dominated by the need to lift the moratorium on PPAs. What guarantees is Kenya Power seeing that when we go that route, the argument of take or pay will have been addressed? And two, remember we had the conversation about the need to convert a lot of our PPAs into local currency denomination as opposed to USD. Will that have been addressed?
Julian, there are basic dynamics that actually inform what actually transpires in that particular space. Number one is that where we are at in terms of the margin, in terms of the generation versus the available generation that we have and the demand, as it were. So when we are now touching on some load shedding as such, then it becomes very necessary and quite urgent to be able to have some generation, and even given the lead time it takes to develop that. And really, when you look at the ones that are quick to generate are actually the solars and the winds, and those are quite intermittent and might not entirely deal with the problem. So now when, as the peers was indicating in the discussions, if we have local financing abilities in terms of being able to fund Kenya shilling PPA, that would be actually the best, because we would not necessarily bring in the foreign currency exposure, but then we would have funding that is long-term for a PPA that is actually local. And these PPAs have some very good stable returns for over the 20-year period. And that would be a very good investment for pension funds and other investment funds to actually consider, because it's actually a very serious investment opportunity, because the country needs it. If you look at our performance and really the various customer categories in terms of the growth of demand, other than the small commercial that indicated a slight decline, all the other categories, especially the industrial and commercial, were actually upward. And that, notwithstanding the fact that there are quite a bit of grid migrations, people going solar and some captive generation happening, but we still see demand growing. So with that pressure on demand and the peak demand that we see, new peak every 3 or so months, really indicates that we are running a risk, if at all we do not have firm new generation, or we are running the risk of even depending on the neighboring countries, like now where we're importing 200 from Ethiopia, 200 megawatts, and we are looking to scale it to 400 in the next 1 or 2 years. So we are likely to end up in a situation where we are really dependent on that. The imports from Ethiopia are also in foreign currency, so that still becomes a challenge on that.
Steve, the year under review, the good numbers notwithstanding, had recurrent incidences of pervasive power outage. national blackouts, we call them. I'm curious as to how this reflected in your numbers. Have you thought through how much did this actually cost Kenya Power?
The kind of interruptions that we had where we have a national outage, and a national outage is not just a flicker that comes on and then the power is back. There are certain standards in terms of the grid safety, the safety in terms of now the people and all that, and the safety of the equipment itself. That there's a protocol in terms of when the power has gone off and how it is brought back. And there are stepping mechanisms around. It's established that there's enough voltage, and then it starts at the plant or the center that actually fires it up, and then it goes cascading, and the entire network is brought back. If you recall, you'll see in the notices that are given to customers around that, usually say that now we have Mount Kenya and West Kenya back on supply. We are working on Nairobi, restoring Nairobi. It is that protocol that happens. Now, to your question, when that is happening, the time that is happening, we are actually not in business in terms of really sales, because for electricity, and unless you have storage, when you lose an opportunity to sell, that's a loss that you've lost. And that speaks to the kind of level of sales growth that you would have had in the absence of those kind of incidents. So it has an impact on the organization as such. And so to the economy, it has an impact because of we power most of the activities that happen, industry and all that. And that affects, and it has a ripple effect across. And so to the cause of that, there are quite a number of causes that would actually do that. The unavailability of a major generator, to the extent that a certain percentage, up to 15%, is not available in an instant, then it causes the grid actually to really shut down and all that. If there's a transmission line that really goes off because of some incident or something happens and all that, it has that possibility of really having a widespread sort of outage on the network.
One of the developments in the recent past has been the draft government state-owned enterprises bill of 2024. And one of the interesting things it proposes is a consideration for entities which are considered to be in public service obligations, like Kenya Power, and that they should be treated with a separate kind of accounting standard. I'm curious as to what thoughts you have around this and what would this mean for Kenya Power, because I'd imagine in something like the lifeline tariff, the last mile connectivity rather, which was quite a strain on your balance sheet, it would be a game changer.
Julian, that really, that bill is a game changer, as you put it. And so it actually tries to address a gap that we have for a very long period of time been trying to struggle with. You remember in previous discussions we've engaged around being a horse and a donkey at the same time. And so this is trying to levelize that, in the sense that when you're a commercial entity, you should not be really dragged down by the fact that you have some public ownership within the structure. And so you find that when the government has its own initiatives, very noble social initiatives like connectivity and all that, and issues like incentives or to concessions in terms of the pricing of electricity and all that, those are not considered on the cost side. On the build-up of the cost, you still have commercial entities that you need to meet their obligations. And then on this other side, the government requires some concessions to its vulnerable. It's actually a government responsibility to do that, and it's very noble. Now, when a commercial entity finds itself in that particular situation, then it becomes sort of like a conflict where even the shareholders, the 49.9%, would actually feel like the major shareholder is really bulldozing, dominating in terms of that, and it has an impact on them. And so we've seen those kind of instances like the reduction of the tariff by 15%, the freeze that we are just talking about right now and all that. And they have a significant impact in terms of even the agility of the business, being able to run the business as commercially agile as possible. And so I think that bill is very, very timely in terms of trying to address those issues.
I wonder, in your thinking, how starkly different would the accounting for consideration of public service obligations be compared to what you currently operate on?
Our accounting considerations are purely commercial, as it were, right now. Apart from the specific projects that usually are donor funded and government funded, that now we look at it from a public sector perspective, we are 100% a commercial entity when you look at our accounting considerations as such. And so that means we are ahead in terms of what the requirements of that bill would be. The key part that that bill brings about is that when an entity like KPLC is now required to undertake those government social kind of obligations, it should actually be compensated or made whole so that it doesn't really incur resources, to do social activities that do not, So that, I think, is the gap that it fills, and that is where the aspect of the commercial consideration or county consideration would come in. But in terms of the reporting and all that, we are already fully commercial entity.
Okay. The first dividend in about 7 years, 7 cents per share, first and final. Market is quite excited. The market is up. I checked it this morning. I wonder, Steve, in my thinking, a bit premature considering the capital constraints you still have. How would you justify that payout?
One of the key roles of a leadership of organization is the value proposition to the shareholders. And so you've spoken about the 7 or so year drought for a dividend for the shareholders. And really, for an entity that is listed on a securities exchange and an entities that in the future would look to go into the capital markets, really to be able to raise funding, and when the time comes, it is important to give consideration to that. And in our market here, dividend has become a very important aspect whenever an entity is able to, in terms of its financial performance and its cash flows and all that. I know what you'd be focusing on would be the negative working capital, and as we've discussed, we have really come a long way with that. And my estimation, based on what we are looking at, is in the next 1 or 2 years, we should be able to really get out of the negative working capital. And so I think it is an important thing. And really, if you look at our shares, which are slightly below 2 billion shares, the kind of dividend that we're giving at 70 cents, and where we are at, really, we have not taken away the capital for the priority projects that we have really done balancing in terms of deciding the kind of dividend, the level of dividends to give. A shareholder would expect a dividend of 3 or 4 shillings given the kind of profit that we have. But I think based on the considerations that we've just discussed, that's how we came about with the 70 cents.
All right. Yeah. How do we stand in terms of arrears to, if at all they still exist, to KenGen? This has been a sticky issue for a long time. Given the kind of numbers we are seeing lately, I'd imagine now you are up to speed in payments.
Actually, we are almost there. If you recall, before the Forex issue, we would be in the regions of 90 days and 90 to 120 days. Yeah, and around there for KenGen and the IPPs and all that. Now, when the Forex issue became at the worst of the Forex challenge that we had, some of these guys were actually 9 months out. And so when we had the market shift in mid-February and Forex was available and the rest, the Kenya shilling was strengthening and all that, we did quite some significant payments. Actually, we had to even space that payments quite a bit. And so so far we accelerated the payments, and so far now, like for KenGen, we are 2 months or less in terms of the payment where we are at now. And with the IPPs still in the same region, nobody's actually 3 months off going. So we are in a good place as it were, and we expect to improve on that as we go forward.
How do this 2 months or less look like from a quantum?
Actually, the KenGen's bill in a month is in the region of about 6.5. It varies depending on the net output that we take in a particular month. And so 2 months out would be, and we have a 40-day credit period with KenGen. Yeah. So ordinarily 2 months would be outstanding because the month for 30 days and then the 10 days are such. So I would say almost like we're on the 3rd invoice or something like that as going. So I would put it in the region of about 16, 17 billion thereabout.
As we wrap up our conversation, Steve, we have seen interesting developments in this market. Energy Act 2019, net metering regulations. We have seen a lot of stuff around this. Open access being discussed now quite openly in this market. What kind of conversations are you having at management level? Because I'd imagine you are seeing this as a real threat at this point.
In the investor briefing, you heard about my MD, Dr. Engineer Siror, talk about quite in detail around the energy regulations and the net metering and open access and all that. And really, those are very active discussions, and really, we have also participated quite a bit in terms of the build-up of the regulations and all that. There are certain specific operationalization aspects that we are still looking into, because as you mentioned, one of the examples is if you look at like the net metering, where a customer downstream is actually generating, and so they use, and then when they have excess, they put it on the grid. There are things that are emerging, because that customer could be generating, say, 300, 300 kilowatt hours or something like that, and then we have transformers in that are of lower voltage than that. And so if this customer was to dump whatever they're generating on that, it would actually have a problem with that transformer. And it's not set up in the regulation as such that the customer would actually put up a transformer that would be able to handle that. So it would appear like KPLC, as the owner of the grid at the moment, would actually have to enhance its grid to actually take up power it may not require based on the dynamics, because also the investment in terms of grid infrastructure is based on where demand is. So if the customer is now generating in an area where there is no other demand, it becomes a challenge to be able, because that's how as you had transmission infrastructure becomes very important to take the power where it is required. And so if you're generating in your own premises and all that, and you'd want to dump onto the grid, then there are certain specific considerations that have to be done, because the voltage stability and the requirements. There's a case where we've had some accidents, and a fatal case actually, where we switch off the grid for maintenance a particular area, and because the customer is generating downstream and dumping on the grid, when people are working on the network, there is all of a sudden there's a voltage, and there are accidents. So those are the kind of considerations that we're actually currently looking at, and really developing some standards that really, as we engage and moving forward, because net metering is happening really even in the developed world, and so we do not want to completely lock it out, but really happen within some standards and some dynamics that would be safe and also reliable, really maintain the reliability of electricity to our customers.
Final question. I was pretty intrigued by the decline in sales to the small commercial. Is it a function of the softening economy? Is it a function of people finding alternatives other than Kenya Power?
Okay, both that would say as such, but there's one aspect that brings that about in terms of the way the tariff is structured now. When you consume 1,500 units, and there are those steps in terms of now that determine that now you are a commercial industrial customer or you are a small commercial customer. And so what the current tariff regime provides is there is a switching between bands. Yeah, and so you'd find that certain specific customers who are small commercial have moved to commercial industrial because of they have reached a level where they have consistently over the last 6 months consumed beyond a certain level, and so they would be on the other side. It would appear like small commercial has really gone down. But to your point again, I think it's important to note that there are certain specific sectors of the economy that have really had a challenge, right from COVID and a bit of the high interest rates and all that. There have been defaults. You've seen auction of properties and things like that in newspapers and all that. That really, there's a ripple effect of such happenings in the economy, and you find that certain specific industries really bear the brunt of that. And so there are certain sectors in that. And as I had mentioned earlier, as an organization, we are looking at ways in which we can be able to really support those kind of our customers who have those kind of challenges in terms of longer payment plans, ways in which we can smart meter them so that they take advantage of their time of use tariff if they can do their work or their production at off-peak.
Steve Vikiru, thank you so much for your time.
Thanks, Julian. Always a pleasure.
We've been having a conversation with Stephen Vikiru, the General Manager Finance at Kenya Power, following the stellar set of earnings released for FY2024. We shall keep tabs on this counter, especially at the stock exchange, to see how it fares going forward.